entries will be on the fair value gaps, entries on FVGs, and we will be looking for either a draw on liquidity or a sweep of liquidity. Now we're starting to see a few bullish candles at this point. We can see prices then started to try pushing lower, and then this is the candle that straight away starts to pique my interest. When I see this candle, this is now telling me, right, we've had a little bit of consolidation when we've opened. We've had a bit of indecision. There's been no clear direction at that moment. And when this candle happens, a very nice, strong engulfing candle, we can see, right, there's a bit more pressure, bearish pressure in the market. So as we move forward, we could then see a fair value gap has formed. So one of the other things I didn't put in the rules up here is the fair value gap size and the stop loss size. So let's talk about that now. So we're going to have a minimum stop loss of 5 pips. We're going to have a maximum stop loss of 20 pips.
How did you come up with those numbers?
It was just more trial and error. So I used Replay for all my back testing, and initially what I did was I just took anything with a large stop loss or a small stop loss, and I gathered about a year's worth of data. I think I showed you how much data I collected on the last auditorium.
Yeah.
Like hundreds and hundreds of trades that I've back tested. I'm a little bit weird this way, actually, by the way. I do like back testing. So if anyone that doesn't know me, I love back testing, and I think it's a huge contribution to how I trade these days. So, and what I did start to look at was the common trades that were more likely to play out. And there was just sort of like a nice fine area between 5 and 20. What I didn't want to do is have stop losses wider than 20, because then we would be expecting a much larger move for our target to be met. But likewise, if I had a stop loss smaller than 5 pips, we would start running into some issues with either slippage, slightly wider spreads, and all sorts of stuff like that. So I wanted to keep it, you know, relatively conservative. I know to some people 5 pips is quite small. There's also a lot of other people out there trading smart money that say 5 pips is really large. So the maximum and minimum stop loss is 5 and 20. Now, if FVG is greater than 5 pips, use a center line. So with this trade here, you can see there's a center line on the fair value gap, and this fair value gap was larger than 5, it was 6.4. So we use the midline, okay? So the pending order in this point would then be placed on the midline. We then have our stop loss on the high of candle 1. So candle 1 is on the fair value gap. So we've got, obviously, this is obviously the fair value gap, requires a minimum of 3 candles. So this candle here, the second candle, which is going to be the one that's going to provide the gap, and then the third candle is the one that makes sure that gap stays open. When that happens, if it's greater than 5, we're going to use the center line. So the order would have been placed there, and then we can advance price forwards. And what I then forgot to mention earlier as well is these are the trading windows. So are those visible? Can you see the vertical lines there? So for this particular trade, this one did not trigger. The pending order didn't fill, but eventually price did move towards our target, which was fine. If that happens, it happens. I would rather stick to the rules, having the entry on the middle of the fair value gap, because then that means I can make sure that my target is reasonable and doesn't exceed where I was trying to aim for. So with a fair value gap, what they are is just essentially like an inefficient point of the market. So some people would define them in certain particular ways and try to provide some, you know, guaranteed logic behind it. But just to keep things nice and simple, we're looking for a minimum of 3 candles. So my indicator only shows me fair value gaps inside this window from 8 till 9. So this is what it's representing. We have this candle just here. Then the very next candle has no candle range encroaching that price area before or after the first or third candle. So imagine this is a candle. We then have another candle here. We then have another candle about here. So what we can see is, I'll just change this color. So what we can see here is each candle is relatively efficient. Now, if we was to move this, something like, let me just move this like this and move this one over here. The low of this candle, the low of candle 1, which is this one here, is higher than the high of candle 3. So what this is showing us, there is a gap in price between this low and this high. that also includes the wicks. So if we see a wick pushing up to here and there's a wick pushing down there, there's no fair value gap. It means that price has been inside that candle's range at some point. So quite simply, what we are looking for with a fair value gap, you tend to see them where there has been maybe a large impulse, more common around market opens. It could be something like around the London Open. It could be around high impact news. They're not only found in those situations, but they could be found more commonly in those areas. But what we might find is also in slightly less volatile areas, like over here, this was during the Asia session, we still had a fair value gap here. So what we're looking at, again, we've got candle 1 here, candle 2, candle 3, and the high of candle 3, so where the wick is, just there, it's much lower. There's a gap between that high and the low of candle 1. So imagine, well, you can draw that sort of rectangular line across there. We can also see there's another one just above. The high of this candle is much lower than the low of this candle, so we have another fair value gap there. So yeah, like I said, this particular trade here, it didn't trigger, it didn't activate. Now what we need to make sure we are doing is we're only taking trades inside the window. Now the trade can only activate inside that trading window. It cannot activate outside. If you have a trade that does activate inside the window, it can run outside the window. Now we do have a cut-off time where the trade will need to be closed. There'll be no trades held overnight. The reason for that is over recent years, the markets do tend to occasionally provide a gap overnight. I'm usually in bed around the daily rollover. So when we have those swap fees, I'm not going to be looking at the charts. I'm not going to be sitting there monitoring the trade or anything like that. So I don't want to have a trade open overnight. And it is also possible, even if you have your stop loss to break even, that if you have a gap that then gaps beyond your stop loss, you can still lose money that way. So even if you have stop loss to break even, you're not completely safe. But yeah, as you can see, this one would have triggered outside the window, and I'm okay with that. If I miss this trade, doesn't matter. There'll be another trade another day. If you see the market going without you, you need to remember the market will still be there tomorrow. The market will still be there next week. It will still be there next year, and it'll probably still be there long after we are, put to the ground. So here's another trade. This was another particular trade that did not trigger as well. The idea for this particular trade, liquidity from the Asia low. Now this happened pretty much as Frankfurt was opening. I don't count Asia still being open up until 9 o'clock like some people would. I'm looking at the point where there's more volume entering the market and Frankfurt is opening at 7 o'clock. And I'm also looking at the point where London opens here as well. So we've seen this wick take out the low of the Asia. And then after that, we can start seeing some bullish momentum. Now, there's not really a clear bullish structure until we start to see something a bit more prominent, like this high here being taken. Now, we probably could, if we wanted to, argue that some of these candle wicks here are highs, and, we can say that actually technically we turn bullish from around here. And I would partially agree. I would also then say that it's quite aggressive, but it would probably be more down to your personal risk appetite if you like to be aggressive that way. I like to see some nice clear defined structure like this before I start saying, right, now we have turned bullish. So at that point we can see we have turned bullish from this point here. Like I said, if you wanted to class this down here, I would say that's a bit more aggressive, but at the end of the day, either way, this one or this one, we can now see we've got some bullish momentum. We've got a candle closure there. I love to see a candle closure. I don't like to use wicks because for me, that doesn't show that there's commitment that price wants to stay above that high or below that low. So the order flow so far from this low is quite efficient. We can see there's no fair value gaps down here. There was a fair value gap just before the window opened. All right, just there, and we can see that that was tapped into. So this one would not have been the trade for us to take because the fair value gap was outside the trading window. All right, but this particular one here, there's a very small fair value gap. I would just zoom into that just in case anyone can't see it, but there is a small fair value gap there. Okay, so at that point where we get the candle closures, we've seen the liquidity sweep, we can exit your trade in as much detail as the entry. A lot of people really put so much emphasis on trying to get the perfect entry, which you could get the perfect entry, but if your take profit or your target is absolutely rubbish, then there's going to be absolutely no reason why that target should be met. So we want to make sure we do have something that is likely going to draw price towards it. And in this particular trade setup, there's a couple of things that we can look at. First off, we have the Asia high. All right, so there's going to be liquidity there. Typically, the London session would do the Asia session. We haven't quite seen that as much during the summer holidays, as you can see here, 19.5 pips compared to 24 pips. But this is kind of summer holiday price action behavior, really. But we've got the Asia high that we can use as a target here. We also have a fair value gap here. We have some supply zones or order blocks, if you want to call it order blocks. All right, so we do have multiple reasons for prices to continue pushing up in this direction to a certain degree. So I'm very happy with where that target would be. However, just like the previous trade, we can see that it didn't trigger our order, and I'm okay with that. Again, I am not getting FOMO. I'm sticking to the rules. I'm sticking to the rules to the letter. If the trade goes without me, it doesn't matter. There will likely be another trade tomorrow, or I also trade GU and UK 100, so there may also be another trade on one of those pairs as well. This sort of trading strategy is probably closer to scalping than it is to like intraday, and a lot of people have the idea that scalpers need to be sat there in front of the charts all day, eyes glued to the charts, and you don't need to be. I quite like scalping, but I also quite like swing trading as well. But for this strategy, I just have those 2 windows in the day. If they trigger, they trigger. If they don't, I don't care. I'll just move on to the next one.